right, well, welcome everyone. Thank you for attending our webinar today on building wealth through real estate. My name is Hayley and I am going to be leading this information session. So this is going to take about 45 minutes, and what we are going to cover are a few different things. Number one, we're going to talk about why investing in real estate. Why is it a good idea? Why do we recommend it? What are the benefits of it? Two, we're going to talk about what you should focus on if you are a real estate investor. So we try to make this as simple as possible. There's three very simple areas of focus. If you can focus on those and follow the systems and models correctly, you will be successful at investing in real estate. We are also going to touch base at a very high level on finding and evaluating properties. We have some great forms to share with you on how to analyze deals. Talk about financing the property and different ways to come up with the funding when you want to purchase. Owning the property and considerations regarding that. We'll also touch on vacation rentals and Airbnb, as I know that has become a very big part of real estate investing in our area. And also really excited to share some local information about the St. Louis market and why we believe this is such a great place to invest. So I'm going to share some statistics and data and information about St. Louis as well, especially for you out-of-town investors. And just sharing some lessons in real estate investing, and we'll open it up to any questions at the end. So before we get started, I want to get a sampling of who is here. So I am going to put a little poll up here. And if you can answer these questions, it will give me a good idea of who is here. So the first question I have here is if you have ever bought an investment property. And the second question I have is what is holding you back if you have not ever bought or if you haven't bought your next one. So first question is if you've bought, second is what's holding you back. And it looks like we've got some answers coming in here. So great. So far, we have a very new audience. So all newbie people that have not yet bought an investment property. And it looks like some of the things holding people back might be fear of failure. Oh, great. All of the different answers, cash, finding the right property. So hopefully today we can go ahead and take some of those fears and help you get past that point so that you can begin your career in real estate investing. All right, great. So first, let's talk about why someone would want to invest in real estate. As you get more income and you get more cash on hand and you want to grow your wealth, there's a lot of different places that you can place your money. One of the reasons, obviously, real estate is my profession. I'll talk a little bit more about my background in a minute, but that I feel strongly about real estate is there are so many benefits to investing in real estate that you don't typically get in other investments. So first, just talking about diversification. As you know, that different investments have risks at different times. So diversifying your investments by putting some in the stock market, some in real estate, just helps create a safer net for you. Real estate can provide an income stream. So that is a huge benefit when you talk about purchasing rental properties and having the tenant pay your mortgage payment and that rent goes into your pocket. Real estate is also not very volatile. So in something that could have huge swings in value, real estate typically might go up a little bit, down a little bit, but it's not going to be hugely volatile and it will never go to zero. I love real estate because it's also a tangible asset. If you own a rental property, you can go out on the weekends, get in your car and drive by and see it and see your investment. So it's not somewhere in a cloud. It's actually something that you can go see and check on. And you have the ability to influence its performance. So if you purchase a property that needs repairs and, letting someone in the waiting room here. You have the ability to influence the performance of your property by adding value to it. It's also protected against inflation. Typically, if real estate values are going up, if inflation is going up, real estate values will be going up as well. Appreciation is a wonderful bonus of real estate. And sometimes that can be like winning a lottery ticket. You might buy a property and the value is going up, but then let's say they put this huge entertainment venue next door and all of a sudden this has become a great place and the value skyrockets and appreciates. So appreciation isn't something to necessarily count on. It's not the only thing, but it can be a huge bonus. And then also looking into the reverse side of that, depreciation and tax advantages. So when you do buy real estate, you get to write off depreciation for parts of the home. And you also can take advantage of tax advantages such as the interest that you pay on it. So tons of benefits. The most important benefit that I see in investing in real estate is leverage. And what leverage is, I'm going to talk about on the next page. Oh, actually, I'm going to talk about our team. Sorry. So first of all, I just want to introduce my team. That was kind of just a little overview of what we're going to be going over today and what the benefits of it are. But my name is Hayley Tomazik, and I am the managing partner of the Curated Properties team. We are a real estate team here located in St. Louis, Missouri. We have over 20 years of combined experience in real estate and are active real estate investors as well. We have a very specialized team. So on our sales side, we do have a listing specialist that works, Lindsay, who works with listings. We also have a buyer specialist, Michelle, who works with buyers. And then I work as the managing partner, team lead, mentor, and coach. So we have found when working with investors, especially, that we can really offer them specialized service in our areas of expertise. All right. Now for the power of leverage. So what is leverage? Leverage is using other people's money. Could be a bank, could be a mortgage company, could be someone that's doing private funding for you to make you money. It multiplies your investment, and the appreciation in the rent is based on a total value of the property, not just what you put in. So your return on investment is calculated by your money invested. So here's kind of just a simple example to show you what I'm talking about with the power of leverage. If you don't take rent into consideration, assuming the property went up 5% a year, which is very conservative. I'll show you a graph later that will kind of verify that over the history of real estate in the United States. 5% of 100,000 is 5,000. 5% is 25% of 20,000. So if you were to buy a $100,000 house and put a 20% down payment down, which is 20,000, your return on investment, if that home goes up by 5%, would be 25% of the money you invested. To make that same money, if you put it into a mutual fund that yielded 10% with no cost, you would need to have $250,000 in cash. So it just shows you the power of being able to leverage your investment. This graph right here is going to go kind of shows you the difference of stocks, mutual funds, money markets, and investment properties. So if we were to buy an investment property at $100,000, we would only need $20,000. If we were to buy stocks, $100,000 worth of stocks, mutual fund, or money markets, we would actually need that full $100,000. Carrying costs, if you're using a stockbroker, you're typically going to have some type of carrying costs of 1 to 4%. An investment property, your carrying cost is your mortgage, which is typically offset by rent if you're holding it as a rental property. For stocks, mutual funds, and money markets, you don't really have other costs, but that is something you need to take into consideration in owning real estate. And that would be your maintenance, repairs on the property, as well as there are times when the property will be vacant. So taking that into consideration. And then your income per year. So, on average, you're looking at 8 to 10% in stocks and mutual funds. Money market, you're looking at 2%. In real estate, you're looking at 5% appreciation, which is on average what we have seen in the lifespan of real estate in the US. You don't get any other income when it comes to stocks, mutual funds, or money markets, but you do get rent when you purchase investment property. So if we're looking at overall return on investment, you're looking at 4 to 7%, 6 to 9%, and 2% for those stock, mutual fund, and money market accounts, and 25% on investment properties. The potential loss, stocks and mutual funds can go to zero. They could completely go to zero. With real estate, you'll never see it go completely to zero. There's always value to at least the land, even if the house were to burn down. So, talking about all of the benefits, I think it's important also to talk about what the disadvantages are of owning real estate, because it is an investment and all investments do have risk. So one thing about real estate is that there is a lack of liquidity. So when you purchase a home, your money is tied up in that home. If you wanted to get your money out, you would have to either refinance it, which means you'd need to qualify for the refinance, or you would have to sell it. And depending on what type of market we're in, it's not always as wonderful of a market it is right now. So it could take some time. There's always risk associated with it. So especially when you consider when you're purchasing a home, doing your due diligence is so important regarding the expenses that might come up. So if there are big ticket items on the property that needs to be repaired, or if there's other expenses that you might not foresee in the future. And last, market conditions. Real estate is subject to the real estate market. So just knowing the risk associated with what would happen if it changed in the market. And I think always looking at that at the forefront is extremely important to make sure that you are making a sound investment. So what are the 3 areas of focus for a real estate investor? Number 1, if you're thinking about investing in real estate, you want to get crystal clear on your criteria. You need to decide what you want to buy, and you need to create a script that goes along with it so you can share with people what you're looking to buy and so when they come across a property, they will think of you. So here are 7 different types of criteria that we like to use in determining what our ideal investment property is. Number 1 is location. Now, this could be hyper local. It could be as small as a certain neighborhood, or it could be a general, I'd like to buy in the St. Louis metropolitan area. The more crystal clear you get on it, the better chance you will get at finding people to send you deals because they know exactly what you're looking for. Type could be single family, multifamily. Are you looking to buy a house? Are you looking to buy a 2-family building? Are you looking to buy a 4-family building? And economic could be what type of rents are you looking to get? What is your price point? Do you want to spend $200,000? Do you want to spend $800,000? Condition is a really important one. Are you looking for something that needs work that you could add value to? Are you looking for something that's just move-in ready that you could purchase and start renting right away? Construction, a lot of times people will set their area of focus on homes built after a certain time. Typically, homes built after the 1980s are going to have much less and much easier to repair, make modifications to. Whereas if you're buying an older home that maybe has plaster walls, has knob and tube wiring, you're going to come across a whole different set of things that you need to take into consideration. And then features of the home. Do you only want to purchase homes that have garages? Do you only want to purchase homes that have 2 full bathrooms? So really just getting all of that straight. And then amenities. Are you looking to buy a property that's in a walkable neighborhood? Are you looking to buy a property that has a pool in the neighborhood? Just coming up with what you want to buy. So here is just kind of an example script of somebody that was looking to buy a rental property. I'm looking to buy in South City, St. Louis, in these particular zip codes. I'm only looking for single family homes, and my goals of these properties is to get cash flow and appreciation. So I'm looking to buy them slightly below market value at 80% of the market value. I'd like to see a minimum of $200 cash flow a month, and have it appreciate 3% a year, needing minor cosmetic repair. I like only brick homes. I want to have newer systems that aren't in need of replacement, and a minimum of 2 bedrooms in a walkable location. If you're communicating this to people, they are going to, if they see a property that comes across that meets that criteria, they will say, oh, Hayley told me that's what she's looking for. I'm going to send it to her. So coming up with what your criteria is so important. And then it also helps you narrow down, because there are so many homes out there for sale. But if you can pick exactly what you're looking for, it will allow you to analyze the ones that are actually within your criteria. So the next area of focus is your terms. So there are tons of deals out there. They aren't all great deals, but there are tons of deals out there. Terms are what create great deals from even the most modest criteria. So everything we went through on that last slide was your criteria that you are looking for. And terms are the negotiable aspects of a purchase. So just because a house is for sale for $150,000, when you plug that into your analysis spreadsheet, that might not make it a great deal. However, you can always take those terms and you can change them around to fit what would make it a great deal. And that's how you can come up with your offer. So we are looking at what you're going to offer the seller. We're looking at what current interest rates are and what can you get for an interest rate. We are looking at down payment. How much do you need to come up with in order to purchase this? Occupancy, is it fully occupied? Will you be able to up the occupancy? Will you be able to, when will you be able to close and start the occupancy? And then what closing costs will you have associated with purchasing it? So terms can really get you a great deal, even if the house for sale doesn't necessarily meet those terms. That's where you can create your offer. I'm going to put in the chat here a few worksheets for you that help you to analyze deals so that you can see what terms you need in order to create a great deal. So I'm going to go ahead and put these in here. And these are Excel spreadsheets. And while I'm putting it in here, the first thing that we have here, this is the cost of repair worksheet. So this would be if you were purchasing a property that needed to be repaired, and it goes through every single thing that could come up on a house. So minor repairs, major repairs. If you're a new investor, this worksheet is great to bring when you go through a property for the first time. And ideally, if you can bring a contractor with you that would have some knowledge of what things cost, so that you can walk through the property and mark everything that the property would need to bring it to the correct condition. The next worksheet that I've attached here is the buy and hold worksheet. So what's neat about these worksheets is they all work hand in hand. So when you're analyzing a deal, you could analyze it as a buy and hold, or you could analyze it as a buy and sell. A property might be a great deal to hold on to as a rental property, but it might not be as great of a deal to purchase, renovate, and sell as a flip. The cost of repair worksheet actually funnels into the buy and sell worksheet and the buy and hold worksheet. So when you go ahead and you pull these up and you look at them, you'll see that the buy and hold worksheet will say, this is the purchase price. This is how much you need to figure for repairs, which is the number that comes off of your cost of repair worksheet. And then you can put in all of the other terms. I am happy to take individual time to go through people with these worksheets on a one-on-one basis, but I wanted to just put all this information here so that you have it and you can begin to analyze deals. Next, our third area of focus is your network. So your network is who is going to help you. And I really have this split into 3 different types of people that need to be in your real estate investing network. Number 1 is your inner circle. It is so important when investing in real estate to find people that have done it, that can help consult you, help mentor you. These are the people that really care about your success and will steer you away from a bad deal and will let you know when they think you've got a home run. So just finding the right people to help mentor you in your real estate investing journey. Typically, people that have been successful in real estate investing want to share that wealth. And there's a great, if you go onto different online communities such as Bigger Pockets or your local real estate investing meetup group, you can typically find those type of consultants and mentors that also could end up being financiers of your project as well. Next is your support circle. So your support circle are going to be the people that can help manage the process for you. Your real estate agents that might help you find a deal, the lender that's going to do your financing, property managers, attorneys. These people are people that can help you with all of your support circles. So if you have a good real estate agent, they should be able to say, here's a great lender that you want to reach out to for financing, or reach out to this insurance person because they're going to be able to get you the best rental property rates. These are the people that support you in each transaction, and you want to develop a great team of people that you can count on time and again that know what they're doing in this arena. Last is your service circle. So your service circle are the people that you're going to have on an as-needed basis. You want to come up with a list of all of these great people to do electrician, flooring, carpet, inspectors, appraisers, and typically your support circle should be able to help you find a great service circle as well. So your network supports you, and this really creates your dream team for real estate investing. Your inner circle are the people that truly care about your financial success, the group you trust the most. They have more investment knowledge than you, more experience, and more success, and are willing to mentor and guide you. They are your board of directors for wealth building. And what separates them from everyone else is not what they do for you professionally, but what they do for you personally. Your support circle is your key fiduciary people. They're looking out for your best interests. You work with them on every transaction, and they can manage any piece of the transaction or all of them. They're really your advice and management. And your service contractors are the specialized people. I can't tell you how important it is to have good service contractors because they can also make or break your deal, and what they charge and how well they do it can cause your deals to be wonderful or cause them to have more issues. And you'll work with them when services are required. So these are the 3 areas of focus. Your criteria identifies the potential deals. Your terms determine the real deals from all of the other ones. And your network supports you on all of your deals. The number one question I get from people, and I think this was mentioned as one of the reasons someone hasn't invested in real estate yet, is where do you find deals? How do I come across a good deal? We're in a crazy market right now. Nobody can get a good deal on a house. Well, I can tell you, I have put 3 homes under contract for myself this year that are off-market deals. And it's just been a matter of using all of these different types of criteria to find the ones that did make the most sense and had great terms. So if you look over on this side here, in terms of how, you're going to see who and how different ways to find properties. Number 1, working with agents such as my team is a great way. We do come across MLS listings. We also come across off-market deals. And so having an agent that knows what you're looking for and can bring deals to you is a great way to find properties. Sometimes there's properties that are on the MLS. Maybe you don't want to be looking at the ones that just came on the market, but looking at the ones that have been sitting there for 3 months and seeing maybe the seller's finally gotten motivated and is willing to take less of a price now, so that you're not in a crazy bidding war like a lot of the new homes are that are hitting the market. Driving by properties and absentee owners. I've actually found quite a few properties in my career by doing this, and I wanted to bring up a great app that you can use for this called Deal Machine. Deal Machine is kind of systemizes the driving for dollars. So back in the day when people were looking for properties, they might see a house that has overgrown grass, the windows on the outside have peeling paint, and you can tell it doesn't look like someone's paying much attention to that house. They would go into the tax records, look up the owner, send them a letter saying, hey, I'd like to buy your house. And it's a numbers game. You keep sending letters, you'll start to get responses. What Deal Machine does is it allows you, it's an app on your phone that allows you, if you're driving by a house, to snap a picture of it. It pulls the address off of like geolocation and can automatically send a letter postcard from you to that person saying, hey, I'm interested in buying your house. We have a great partner at Deal Machine, and we're going to be putting on a webinar later this year specifically with them and letting you know all of the benefits that come with using their app. Wholesalers are a great place to find investment properties. If you join local networking groups in your town, there are Facebook groups, there are meetup groups, there's wholesalers, you can just get on their list. They will continually send out properties, and that's a great way to find properties that is at a discount as well. And then there's actually, in this last couple of years, been a big push to online types of purchasing real estate investments. So One that I wanted to bring up in particular was Roofstock. This is a website that you can go on and you can look at real estate deals throughout the entire country and purchase them there. Typically, they're fully rented homes, so you don't have to worry about finding a tenant, and very easy to analyze. And also, there's a lot of people that still purchase real estate through auctions on the courthouse steps or through tax sales. So there's so many different ways to find real estate, and you just have to figure out which way you like to do it and what is enjoyable for you, and find it that way. So in speaking about finding deals, I wanted to bring one up today because my team just listed a great 4-family in the South City area of St. Louis that has a great potential. The owner actually was originally living in one of the units, relocated out of town, and wants to sell it now. So it has a lot of potential. 3 of the 4 units are already rented. They're rented for $525 a month. It's about 3,100 square feet, and each unit has the exact same layout, 2 up and 2 down. We did just list it for sale. It's an as-is sale, and it's $199,900, which is $50,000 per unit. Just another reminder of how affordable our St. Louis market is here compared to other parts of the country. In terms of repair, one of the units does still need appliances. It has cabinets, but it needs them to be finish work, some plumbing repairs on the home, and I'm sure an inspection might bring up some other things that need to be done. And so, I'm going to go back real quick. I did bring up an analysis spreadsheet that I am going to pull up for you. So that we can take a look. And I've got it pulled up in the chat here so that you do have a link to it if you want to review it yourself. And then I'm also sharing it now. Can everyone see this? Okay. So I love this spreadsheet here for real estate investing, because it's a very easy plug and play. I can put the numbers in and I can see if it's a great deal. So right here, we've got the purchase price of $199,900. And then I put about $20,000 in improvements to get it market ready with the unit and just doing some last minute updates to the property. Closing costs, you're going to look at what closing costs you have associated with getting a loan. And so those red numbers are what I plugged in here on cost assumptions. Financing assumptions, we did a 20% down payment. If you were doing this as an owner occupied, you could even probably put less down. So 20% is standard for doing a investment property typically. And then the interest rate, I use 3.7%. We're at about 3.1% for first-time homes, like owner-occupied homes, so slightly higher for an investment property, and a 30-year mortgage. Now next, right now the rents are $525, which I believe to be below market value. So I plugged in $600 if we were to purchase this and do some updating to the property. And I also used a vacancy rate of 10%, which is on the high end to be conservative. Number of units, we put 4 units right here. So if this was a single family home, you'd just put 1 right there. An average tenant stay in years 2. So inputting all of those figures, let's see what we're looking at here. Now here I also had to put some expenses in. So we have property taxes, which I pulled from the tax records, $996 a year. Property insurance, I used an average of $1,200. I also used an average of $1,200 in maintenance/repairs a year. And I factored this with property management of 10% of the income. So this would be with using a property manager. Tenant placement fee of $1,200 a year if you're using a property manager. That can vary and depend on which property manager you're using. And then tune-ups on the HVAC system each year. So this one has no central air, just furnace. Sewer costs, which it depends on where you are and how it's charged, but typically in our market, the landlord would be taking care of the sewer charge. Lease renewal fees through the property manager, water, and lawn care. So using all of these expenses here, if you look at year 1, we're going to look at the rental income, which we've got $28,800 a month. We're going to factor a 10% vacancy rate. to give us gross income of $25,900. For expenses, our total expenses are about $11,175 to give us a net operating income of $14,745. Now, looking at cash flow, we're going to look at the amount that we have plugged in for the mortgage, and we have mortgage of $8,887. So our total cash flow is $488 a month on average, or $5,858 a year. When we look at our cash ROI, it gives us about 9.37%. And total ROI of about 14%. ROI stands for your return on investment. So the cash ROI is the return on the cash that you had out of pocket, and your total ROI is just your total return on the investment. These numbers here, 10% to 14%, are good numbers. I typically don't want to see anything below 8% for my own personal terms, but everyone has different comfort factors of what they are looking for. What's neat about this spreadsheet is it shows us over time how, if we look at annual, increases in revenue and operating expenses, in time, how our rents can increase and our revenue can increase. And we're going to scroll down here and looking at our 30-year totals. The great thing about investing in real estate is all of this time, while these buyers or renters are paying their rent, they're paying down your mortgage. So not only are you getting cash flow each month, but your investment is continuing to grow and appreciate, and your mortgage is getting paid down. So these numbers here, the 9.7 or 37% and the 14%, these are the cash flow with using property management. If you look here and you said, well, I want to do my own property management, you can see those numbers are even higher. So if you have any interest in this property or want to learn more about it, let us know. It was just listed this last week, and I think it's a great deal and a home run for someone. All right, give me 1 second here. Let me go back to sharing the presentation. All right, so next thing to talk about is financing your investment property. There are many different ways to finance investment properties, so we just wanted to talk about a few here. First, you can buy a multifamily unit as your primary home and rent out the other units. This is a great way to get started if you're really wanting to build a career in real estate. FHA actually has a loan product that you can purchase an investment property with as little as 3.5% down. So for example, on this $200,000 house, with as little as 3.5% down, you could get into owning an investment property. It's a great way to get started in investing. Another kind of untraditional way is self-directed IRAs, which you can actually get an IRA and take that money and use that to invest in real estate. There are some strict rules around it. You can't use it for your own personal benefit, but it's a great way to do it. And then also hard money is a way, if you're not doing traditional financing, where you're going to pay much higher interest rates. Typically, you only want to use them for short-term situations like a buy and a flip because the costs are higher, but you typically have a lot less qualification that you need to go through with hard money. Renovation loans, so FHA 203K, this is actually when it's a primary residence, but this allows you to renovate the property as part of your mortgage. So if you're buying a house and you don't have the funds to do all of the renovations needed, there are some renovation loan products out there, such as the FHA loan, and then there's also conventional loans that might require a higher percent down than traditional, but allow you to finance those renovations in. You typically have to use certified contractors that have been approved through the loan programs, but they do allow some sweat equity. And then the most traditional way to purchase is to go with your, let me skip back here. The most traditional way to purchase is by getting a traditional mortgage. These typically require 20 to 25% down. They offer 30, 20, and 15-year fixed rate options. It also, depending on the price point that you're paying, if you own your current home, you can use a home equity line of credit and borrow up to 90% of your home's value. That can give you interest-only payments, lower fees than taking out a traditional mortgage. So if you were looking to buy a much lower property, that's a great way to utilize that equity. And then the other option is to get a commercial loan on the property. So when you're looking at commercial loans, they're not going to be those fixed 30-year rates. They're typically a shorter term with a balloon, which means that you will take the mortgage out on the property, you will have a 3 to 5 year rate, and then at the end, that loan will be due with a balloon. So it's amortized over a long period, but due in a shorter period. But once again, depending on what you're looking to do in purchasing the property and how long you're looking to own it, these can be a great option. They typically require less work than going through a traditional mortgage as well. And a lot of times they'll offer interest-only payments, which is great. Sorry about this right here. All right, so now let's talk about owning your investment property. A lot of times people will ask me, how do I price a rental property and where do I come up with what the rents would be? Typically, I use a 3-prong approach to pricing my rental properties, which is looking at it from a bunch of different angles. So I love the website rentometer.com. You can easily go on that website. You can type in where your home is located, how many bedrooms it has, and find an average and a median price of rental homes in the area. Also looking at competition. So Zillow is a place where a lot of rental property is marketed. It's great to look on there and see what am I up against and how does my home compare to the other homes that are listed for rent. And last, utilize your realtor partners. We can go on the MLS and we can pull rental comps so we can easily see what houses have rented for in the area. So once you've got your rental property priced and you need to find and manage tenants, how do you do that? So there's a couple of different options. The easier route in terms of less stress on you is to use a property manager. They will typically charge at least 1 month for placement of the tenants and then typically around 10% of the monthly rent to manage it. Their job is to find the tenant, they provide the lease agreements, they handle an escrow account for the security deposit, they manage all the repairs, and they handle monthly rent payments. So that's kind of what you're paying for them in that 10% a month to manage. Self-management, there's a lot of different systems out there. I use Zillow Property Manager. It's a no cost fee. I think they do charge for you to post the property on Zillow, but once you're managing it, it does allow you to collect rental payments. It allows you to send your lease agreements and have everything signed through there. Also allows an online system for your tenants to pay each month. When it comes to maintaining the property, that's one thing that if you're self-managing, you would be responsible. So you could get that call on a Saturday that the water heater went out, or it seems like always on holidays when issues arrive, possibly with plumbing backups or whatnot. We have a couple in St. Louis, great companies that offer some great products that can be used for self-managing. So I always like to bring this up because Hoffman Brothers is a one-stop shop for all plumbing, electric, and HVAC. And they have a great home protection plan here that's for a nominal fee each month, but gives you priority for phone calls and also gives you, I think, 10% off services each month. So having someone to handle all of those plumbing, electric, HVAC, which are kind of your big items that come up, is one great way to use that for self-managing. And then it's always important to be able to have a local handyman that can do those odd jobs that come up. Sometimes if you don't have that, there's websites online such as TaskRabbit too, where you can put a request out and then people can reach out to you that can make those repairs. So next, let's talk about vacation rentals and Airbnbs. When looking to purchase those and analyzing those deals, you would use the buy and hold formula worksheet, but you also need to factor in some other things. You have to factor in furniture. So if you're buying an Airbnb, you need to purchase the furniture so that it's fully furnished when people come to stay. You're also going to have much higher maintenance fees because you're going to have cleanings every single time it turns over, and it's getting a lot more use. So it might have more repairs because people are constantly coming in for a short period of time. There's also a lot of taxes and fees associated with utilizing platforms such as VRBO or Airbnb. And depending on the municipality you live, they might actually tax you. So in the city of St. Louis, if you rent your place as an Airbnb, you're considered a commercial property and your tax rates are higher. So understanding that, and also understanding if it's even allowed in your municipality. I know in the St. Louis area, there are certain municipalities that have rules regarding the short-term rentals or don't allow it at all. So that's all stuff to take it into consideration when looking to purchase a vacation rental. There are specific property managers for vacation rentals. So just one here in our local area is JZ Vacation Rentals that can handle all of that for you. I keep going backwards. Sorry about that. Running rental analysis, AirDNA is a great website that you can see average daily rates. You can see annual revenue and occupancy rates to help you plug those right numbers in. And a huge thing would be to talk to other Airbnb owners first, learn from their mistakes. What did they do when they first bought theirs that they wish they hadn't of? That's really the best way to learn. So now let's dive into the St. Louis rental market. As you can see, we have this beautiful river city right here with our famously known arch. And we are one of the most affordable markets in the country. So we're smack dab in the middle of the country. Our median home price is $175,000, which was a 9% growth from 2019. This was in 2020. And we have a lot of out-of-state investors investing here because their markets are expensive and our market isn't. We also have a great improving tech scene. Ag tech has gotten really popular. We have a huge geospatial space going in just north of downtown. We have a great Cortex Innovation District, which is a lot of startups have located in, and we are seeing rising rents. So in our metro area this last year, rents rose by 4%, which our average rent is $9.98. And over the last 6 years, we've averaged 2.7% in rental increases. Meanwhile, larger markets such as New York have actually seen rent decreases due to COVID. I think I mentioned this graph here, just talking about the median sale prices of homes in the US since 1965. So I always like to bring this up because I think anyone that's gotten into real estate in the last 10 years is a little hesitant because of what we saw happen in 2008 to 2012. So if you look at this graph, you're going to see this is back from like the 1960s. What real estate values have done. So down here, they were averaging around 35,000 and they've continued to go up throughout time. You do see times that they do correct and make little dips in the market. You'll see that. But generally, we have seen real estate values climb and climb and climb. And this is actually only up to 2019, but it continues to go up from there. This graph here just shows in the St. Louis area since 2008 what we've seen prices do. So this was that large dip that you saw on the large scale, but this is just our market here in terms of what our average prices have done. So this just goes back to that initial slide I showed you of if you bought a home for $100,000 and you only had to put $20,000 into it, your actually home would be appreciating off of the full amount, not your cash amount. The vacancy rate in the St. Louis market is low, between 6 to 8%, and that's been steady for the last 10 years. And I love this stat here. 30% of all households in St. Louis are renters. We are seeing millennials renting longer due to student loan debt and rising house prices and very tight inventory available for sale. So the rental market is extremely strong here. And if you have a good product, you will have no problem filling your vacancy. Realtor.com actually ranked St. Louis in the top 10 cities for house flipping in the whole country. So that's a cool stat right there. One recommendation that we have if you're doing a flip for the first time is to start with a lower price point because a small flip is much more manageable than a large home. And there's a lot more people buying those starter homes than there are the luxury homes. So just a great way to kind of start and break in. Wanted to bring up a couple of neighborhoods of interest in our area. We have great pockets of city neighborhoods here. A lot of the Southampton, Northampton, Lindenwood Park, Dogtown, they have smaller homes. They're very stable, lots of buyers, lots of renters looking, very low risk. And then we also have some areas that are surrounding some vibrant art districts and restaurant districts where the housing prices are a little bit more volatile. You'll see a little bit more transitional, maybe some vacant homes on the street, but also a ton of reward because house prices are going up in those areas drastically. So it can be a home run with a little bit more risk. In St. Louis County, we have a lot of great little inner ring subdivisions as well. Maplewood, Kirkwood, Webster. North County has much lower price points, tons of great renters, and we've seen all of these areas increase in value. And in the city, like I said, we have so many vibrant neighborhoods. Just looking for proximity to parks, restaurants, metro area. The St. Louis City Crime Mapping is a great website to see if there are any problem properties on the block. So you can go in and type in the address and see what type of crime has been happening and if it's something to be concerned about investing in that area. St. Louis County short-term rentals, we've seen a huge increase in demand for short-term rentals in these specific neighborhoods. What's great about these is that you can charge a huge premium with it being a short-term rental. A lot of people that are moving to the area want to stay in these areas, or they're renovating their house and they just need a short-term. And so you can really purchase at a reasonable price and charge a premium for rent. And then probably one of the most stable areas for appreciation and for rent are the areas surrounding WashU, because we do have Washington University here and a lot of student housing, great area to lots of 2-family, 4-family properties. Last, I just want to leave you with some resources here in real estate investing. Bigger Pockets is a podcast that we love. It's great for just learning as much as you can about investing in real estate. Think Like a CEO is actually the podcast from Keller Williams, which is our real estate brokerage founder, and has tons of great information. Same for The One Thing, that came straight from Gary Keller and is a way of building your lifestyle around success. And then some other real estate podcasts that we love, Everything Life in Real Estate and Empire Building. Our favorite real estate investing books, Millionaire Real Estate Investor, Rich Dad Poor Dad, The One Thing, Profit First, Atomic Habits, and the BRRRR method, which is buying, rehabbing, renting, refinancing, and repeating. Some websites that I mentioned today in this podcast: Zillow Rental Manager, Deal Machine, AirDNA, Bigger Pockets, and Roofstock are all great websites to check out. And so what are the next steps? So I would say if you're looking to get started in real estate investing, step one, read this book. This is a great, just overall, a lot of the information that I pulled today is from this book on real estate investing. Talk to a mortgage professional, find out how you can get financing. Talk to a financial professional, talk to them about, I want to invest in real estate. I want this to be part of my portfolio. And then reach out to Curated Properties and let our team of people help guide you and find the right rental property. Thank you all so much for attending today. If you have any questions, I will hang on afterwards, and we hope you get your career in real estate investing started.